Dollar rising this morning on the back of that hotter than expected CPI. But our next guest saying that the doubts for rate cuts combined with political risks could suggest that the stronger for longer dollar could remain. We're going to bring in Jane Foley, head of FX strategy at Rabo Bank.
The US economy, it's certainly a lot more resilient than other major economies. I'm focusing here particularly on Europe, but certainly if we look at China, if we look around the world, we see a lot of weakness elsewhere. And so you have this point of time where the market consensus is quite strongly in favor of an ECB interest rate cut in June, whereas every week it seems that more data from the US is chasing away at the possibility of a spring or even a summer rate cut from the Federal Reserve. So that in itself, interest rate differentials is favoring the dollar. But as you mentioned it, there are geopolitical concerns. They could create some safe haven bid for the dollar. The Fed have made it very clear for quite some time that they are data dependent, and they still are. But I think what they were hoping for in today's US CPI report was perhaps some evidence that the stronger inflationary impulses that we've been seeing over the last couple of months, perhaps they were just bumps in the road. And in fact, the fact that we got a stronger number today means that maybe these aren't bumps in the road. Maybe inflation is just much more stickier than they hoped it would be. Now, before the summer, we will, of course, have more US data.
In the FX space, what would you be looking at to indicate that the market is pricing in November as the first cut?
Well, of course, first and foremost, we must look at the economic data, and there's an awful lot of figures between now and November. In fact, there's a lot of data between now and September, which could, push us in either direction. But clearly the market is taking on board the risk that this resilience of the economy, the resilience of or the stickiness of inflation could continue. But as we get to November, well, we do have the election there, and that's politically difficult for the Federal Reserve. They know you could make an argument that if they can't cut by September, well, maybe they won't be able to go until after the election.